Imagine a world where immense wealth is built, not just by brilliant minds, but by an intricate dance of power, ambition, and an unseen force pulling the strings. This is the journey through the cutthroat levels of private equity, from the eager analyst to the towering senior partner, revealing the true cost of success and the quiet engine that drives it all. Level 1, the analyst. You left Goldman Sachs for this, a smaller desk, a floor so quiet you can hear someone close a door 3 offices down. 14 people making decisions about $2 billion. And you, at 24, 2 years out of banking, are one of them. The pay cut stung. Your base salary dropped from $110,000 to $105,000. On paper, that's nothing. But your bonus. It's no longer about how many deals your group closes. Now, it depends on how the fund performs, all $2 billion of it. That's not a small difference. That's the difference between working for a paycheck and working like you own the place. Your job is to read CIMs, confidential information memoranda. They arrive by the dozen, 60-page documents from investment banks pitching companies for sale. You read every one. You build screening models in Excel, 3 tabs, 14 assumptions, 1 output. Does this company clear the return threshold at a reasonable purchase price? Most don't. You flag the ones that do. The vice president reads your flags. He responds to maybe 1 in 5. The rest disappear into the pipeline tracker and never come back. You build your first LBO model in the 2nd week, a leveraged buyout. You've built LBO models before at the bank, but those were for pitch books. These are for decisions. The difference is that someone will actually deploy capital based on the numbers you type into cell D47. You check the model 3 times. You check it a 4th time at 11 o'clock at night in the back of a cab because you remembered a depreciation schedule that might be wrong. It isn't wrong. You check anyway. At this level, an error doesn't cost you a bonus. It costs the fund's limited partners real money, pension funds, endowments, sovereign wealth. People who will never know your name are relying on your cell references. The hours are better than banking. Not good better. You work 60 to 70 hours a week, fewer during quiet periods, 90 during a live deal. The difference is the silence. At Goldman Sachs, the floor hummed with movement, voices, the performative urgency of 50 analysts. Here, the office holds 14 desks and the occasional sound of someone closing a door to take a call they don't want you to hear. The silence is productive. It is also isolating in a way you did not expect. Your total compensation in year 1 is $220,000. No carried interest. You are too junior for carry. You won't participate in the fund's profits for years. You are building the foundation of a career that pays in a currency you cannot access yet. Level 2, the associate. You have an MBA now. 2 years at Columbia, $190,000 in loans. You return to a different fund, larger, with $8 billion under management. The firm hired you because your banking background was healthcare, and their newest fund has a healthcare vertical that needs execution capacity. You are 28. Your base salary is $175,000. Your bonus will be somewhere between $150,000 and $250,000, depending on deal flow and your performance review. Total first-year compensation will clear $350,000 if the year goes well. The year goes well when deals close. Deals close when you do your job. Your job is the deal, end to end. You source it, screen it, model it, fly to the management presentation, lead the diligence work streams, draft the investment committee memo, and sit in the room while the partners decide whether to commit $280 million to a company you have spent 9 weeks learning every detail of. You know the CEO's background, the CFO's modeling assumptions, the customer concentration risk in the top 3 accounts, and the exact EBITDA adjustment the seller's banker is trying to sneak past you on page 34 of the quality of earnings report. You flag it. The partner nods. The adjustment is rejected. The purchase price drops by $6 million. Nobody says thank you. The deal itself is the acknowledgement. You close your first deal as lead associate, a $420 million acquisition of a specialty healthcare services platform. 65% debt, 35% equity. The capital structure has 3 layers, a senior secured term loan, a mezzanine tranche at 12%, and the fund's equity check of $147 million. You built the waterfall model that shows how each layer gets repaid under 12 different scenarios. The base case projects a 2.4 times return on invested capital over 5 years. The downside case still clears the hurdle. The upside case, if the platform executes 3 bolt-on acquisitions and hits the margin expansion targets, returns 3.7 times. The partners approve. The wire goes out on a Wednesday afternoon. You feel something you did not feel at the bank. Not pride, exactly, but proximity. At the bank, you built the model and someone else made the decision. Here, you built the model, defended it, and watched capital move because of it. The distance between your work and the outcome collapsed to 0. That proximity is the reason people take pay cuts to move to the buy side. It is also the reason the pressure never fully releases. When the money is real, the mistakes are, too. Exit conversations happen around you constantly. Hedge funds call, corporate development roles at portfolio companies. A classmate from Columbia took a strategy job at a Fortune 500 company. She earns less but flies home every night. You think about this on a Sunday evening while rereading a management presentation for a Monday meeting. You stop thinking about it by Monday morning. The meeting requires your full attention, and the company is interesting, and the work is the work. Level 3, the Vice President. The title changes the physics. You are 32. Your base salary is $250,000. A bonus brings your cash compensation to somewhere between $500,000 and $700,000 in a strong year. For the first time, you receive carried interest, a fractional allocation in the current fund. Your carry points are small, perhaps 0. 1% of the fund's 20% profit share. On a $7.8 billion fund that returns 2 times capital, that allocation is worth approximately $700,000 over the life of the fund. It invests over 4 years. You will not see the cash for at least 5. This is the first time in your career that your compensation depends on something you cannot calculate on a Tuesday afternoon. It depends on the fund's performance over a decade. The time horizon of your incentive just expanded from 12 months to 10 years. You start thinking differently, not quarterly, but cyclically. You run deals now, not support them, you run them. You manage 2 associates and an analyst. You coordinate legal counsel, diligence advisors, lender negotiations, and management team interactions. You are the person the CEO of the target company calls when he has a question at 9 o'clock on a Thursday night. He is 54. He built the company from nothing over 22 years. He is selling it because a partner at your firm convinced him the platform deserved institutional capital to reach the next level. You are 32, and you are telling him how his company will be restructured post-close. He listens because your firm is writing a check for $300 million. That check buys attention. It does not buy trust. Trust is something you will need to earn over the first 100 days, then the first year, then the 5 years you hold the asset. Portfolio management becomes half your job. The deals you helped close as an associate are now companies you sit on the board of, or attend board meetings for, or receive monthly financial packages from that you review line by line looking for the variance that explains why Q3 EBITDA came in 4% below plan. You find it, a supply chain disruption in the Southeast region that increased COGS by 300 basis points. You call the CFO. She already knows. She has a mitigation plan. You review the plan, push back on 2 assumptions, and report to the partner that the situation is contained. This is the job of a VP. You are the connective tissue between the fund's capital and the company's operations. Neither side sees you as one of them. Both sides need you. You are sourcing your own deals now. This is the wall. Below VP, you execute. Above VP, you originate. The distinction determines whether you make partner or plateau. You begin attending industry conferences, not for the panels, but for the hallway conversations. You take CEOs to dinner who are not yet sellers. You build relationships that will mature in 18 months, or 3 years, or never. Most of them, never. The conversion rate on proprietary deal sourcing is low. But proprietary deals, the ones your firm finds without a banker running an auction, have higher returns because the purchase price isn't bid up by 12 competing funds. Your value to the firm is now measured by the quality of your network, not just the quality of your models. Level 4, the principal. You brought in your first deal, fully originated, a $600 million acquisition of a business services company you identified 14 months ago at a conference in Dallas. The CEO remembered your name. He called you before he called a banker. Your firm won the deal without an auction. The purchase price was 5.8 times EBITDA, a full turn below where it would have traded in a competitive process. That turn of EBITDA is worth approximately $100 million in equity value. You saved the fund $100 million by remembering someone's name and following up 11 times over 14 months. This is what origination looks like. It is patient, repetitive, and indistinguishable from friendship until the moment it becomes a transaction. You are 36, a principal. Your base is $300,000. Cash compensation, including bonus, is between $800,000 and $1.2 million. Your carried interest has increased substantially. You now hold meaningful points in 2 active funds. If both funds perform to plan, your carry will be worth between $8 and $12 million over the next 7 years. This number is theoretical until the exits happen. The exits depend on the portfolio companies hitting their operating plans, which depend on management teams executing, which depend on markets cooperating, which depend on interest rates, consumer demand, regulatory environments, and the specific details of 100 decisions made by people who are not you. Your wealth is a function of other people's execution. You manage this by managing them. That is the entire job description at this level. You sit on 4 boards. You attend 16 board meetings a year. You review more financial statements than most CFOs. You approve capital expenditure requests, management incentive plans, and bolt-on acquisition targets. You are not an operator. You are an owner who does not operate. The distinction creates a specific kind of power and a specific kind of distance. You know the business intimately from the numbers. You do not know what it feels like to walk the warehouse floor at 6 o'clock in the morning. The CEO does. He reports to you. The asymmetry is structural, intentional, and occasionally the source of tension that never fully surfaces in a board meeting, but is always present underneath it. The partnership decision is approaching. You have been at the firm for 8 years. You know the criteria: revenue attribution, deal performance, LP relationships, cultural fit, and the willingness of existing partners to dilute their own economics to make room for you. That last criterion is never stated. It is the most important one. Level 5, the partner. You made partner, 1 in maybe 15 associates who started at your level 8 years ago. The others went to smaller funds, corporate roles, operating positions at portfolio companies, or business school a second time to reset. You stayed. You are 39. Your compensation is no longer a number you negotiate annually. It is a share of the fund's economics. Management fees, 2% of committed capital on the newest fund of 11. $4 billion, generate $228 million a year for the firm. Your share of that covers your base and your team. The real money is the carry, 20% of profits above the 8% preferred return, split among the general partners according to an allocation that reflects tenure, origination credit, and the internal politics of a 14-person partnership. Your allocation is 6% of the carry pool. On a fund that returns 2.5 times capital, your personal carry is approximately $34 million, paid out over the fund's harvest period as portfolio companies are sold. You will not see most of that money for years. Some of it is subject to clawback provisions, meaning if later exits underperform, you may owe money back to the limited partners. Your net worth on paper is significantly higher than your liquid net worth. You own a house worth $2.8 million with a mortgage you could pay off but don't because the after-tax cost of the debt is lower than the expected return on your invested capital. Your accountant structured this. Your financial advisor manages the rest. You now have both. You also have a tax attorney, an estate planner, and a family office consultant who told you that you don't quite need a family office yet, but will in 3 years if the fund performs. Your job is fundraising, deal origination, and firm management. You fly to meet limited partners, pension fund CIOs, endowment directors, sovereign wealth fund allocators. You present the fund's track record in conference rooms that are indistinguishable from each other across 4 continents. The presentation is 42 slides. You have given it 67 times. The questions are always the same: what is your edge? How do you source proprietary deals? What happened with the company in Fund 3 that wrote down? You answer the write-down question with practiced calm. You explain the market conditions, the management team changes, the lessons learned. You do not mention that the write-down cost you personally $1.8 million in carry. The LP nods. He commits $300 million. You thank him. You fly home. Your daughter is 11. She asked you last week what you do. You said you help companies grow. She asked how. You started to explain leveraged buyouts and stopped yourself. You said you find good businesses and give them money to get better. She said, "That sounds easy." You said, "Yes." You did not tell her about the CEO you replaced in Q2 because the revenue targets weren't met. You did not tell her about the 800 people in the manufacturing division that were let go during the restructuring you approved. You did not tell her that the restructuring added 400 basis points to the margin and increased the enterprise value by $220 million, which is the number that matters to the fund, which is the number that pays for everything. You told her it sounds easy. You went back to your laptop. Level 6, the senior partner. You are 47. You have been at the firm for 19 years. The fund you helped raise last year is $15.6 billion, the largest in the firm's history. Your name is in the marketing materials. Limited partners reference you by first name. Industry conferences seat you on the keynote panel. Junior analysts at banks Google you before pitch meetings. You are institutional. Your carry allocation across 3 active funds represents unrealized value in excess of $90 million. Your annual cash compensation, management fee share plus realized carry from older funds, has averaged between $8 and $14 million over the last 4 years. The variance reflects exit timing, not performance. The performance has been consistent: 2-3 times net on Fund 4, 2-1 on Fund 5, 1-9 on the current vintage, still early. The numbers define you inside the LP community. They are the reason capital flows toward you and not toward the 400 other funds competing for the same allocations. You sit on the firm's investment committee. Every deal the firm pursues requires your vote. You see 50 opportunities a month. You approve 4. Your pattern recognition, built over 19 years and 63 completed transactions, allows you to identify the flaw in a thesis before the associate finishes presenting it. The flaw is usually the same: revenue concentration, customer dependency, management depth, or a growth assumption that requires the market to cooperate in a way it has not cooperated in the last 2 cycles. You kill deals quickly. Speed of rejection is a skill nobody teaches and everyone who makes partner possesses. You have missed your son's basketball games enough times that he stopped telling you the schedule. He is 15. He texts you the score afterwards. You respond with a single word. The word varies. The distance does not. Your wife manages a life that functions around your absence. She does not complain. The absence is not a failure. It is the structure. The structure is the fund cycle, the deployment period, the harvest period, the fundraise, the next fund, the next cycle. The structure does not pause. It does not ask about your weekend. It asks about the Q3 board deck and whether the add-on acquisition in Portland is on track to close before year-end. You are the most successful version of the person who left Goldman Sachs at 24 because a headhunter said, "Buy side." You have created more than $1 billion in value across your career for the fund's limited partners. Pension funds that manage retirement accounts for teachers, firefighters, and state employees have compounded returns because of your decisions. This is real. You think about it sometimes. You also think about the companies you restructured, the jobs you cut, the management teams you replaced. The math always worked. The math always justified the decision. The question you stopped asking around year 12 is whether the math is the only framework that should apply. There's someone your fund depends on who never appeared in any of these levels. She is 36 years old. She works at a state pension fund managing $41 billion in total assets. Her title is Director of Private Equity. Her salary is $214,000. She controls $9.3 billion in alternatives allocation across 67 fund relationships. Your fund is one of them. Last quarter, she recommended a $300 million commitment to your newest vehicle. The investment committee approved it in a 40-minute meeting. That single commitment represents more capital than your fund's entire first vehicle raised 20 years ago. She made the recommendation based on your track record, your team stability, your operational value-add framework, and a 2-hour meeting you had with her in a conference room in Sacramento where she asked you 14 questions and you answered 13 well. The 14th, about key man risk and succession planning, you answered adequately but not precisely. She noted this. She will decide next year whether to re-up for Fund 7. If she does not, and if 3 other LPs follow her lead, your fund will be smaller. A smaller fund means lower management fees, fewer deals, less carry, and a shift in the power dynamic at every level of the firm. She does not manage money. She does not source deals. She does not sit on boards. She allocates. Allocation is the quiet engine beneath everything you built. Every partner, every principal, every associate running diligence at midnight is working inside a structure that exists because someone like her decided it should. She goes home at 5:45. She eats dinner with her family. She does not think about your fund after 6 p.m. She will again on Monday briefly while reviewing the quarterly performance report you spent 40 hours preparing. She will read the summary page. She will note the net IRR. She will move to the next fund in the stack. There are 66 others.